What's up, everyone? Excited to give this video today about Penn Entertainment, which was formerly known as Penn National Gaming. So the company has been underperforming the general market over the past couple weeks, and unfortunately, that is somewhat hurting the share price and has been causing shares to drop. So the underperformance is somewhat shocking as the company does have a pretty solid valuation. And I'll get into, I'll give a price prediction for shares here. I'll get into the fundamentals of the company. Then I'll dive right in to the financials of the stock. So got a lot to cover in this video, so I will jump right to it. So Penn Entertainment has been forming this support level at about $23. And first off, this is not financial advice, so please do your own research. So we've triple bottomed off this $23 level, which I believe signifies that this level will likely hold and we will see a continuation higher over the coming weeks. So that being said, I do believe the bottom is in for Penn Entertainment, but unfortunately shares are still below all daily moving averages, which signals bearish momentum. Also, we had the 50-day moving average cross below the 200-day moving average in late February, which for those that don't know is called a death cross and signifies bearish momentum. So with that being said, I do think shares likely continue higher, but I would need to see a move above all daily moving averages, which is about $29. So if we're able to get a move up to $29, I think we are very likely to see a move higher. How much higher? Well, I think about $39 is a good kind of top you could see in the stock. 39, 40 bucks, this kind of general level. Let me just delete that, drew that kind of wacky. So this is where shares had topped out in December of 2022. So also where shares had topped out in August of 2022. So you can see that here in August. Also where shares had topped out in April of 2022. So definitely a level in which we have seen some selling pressure in the past. So I think once we're able to get above these daily moving averages, we should see a move higher to about 40 bucks over the coming weeks. So that is my price prediction for shares. But before I got bullish on the stock, before I get bullish on the stock, I need to see a move over these daily moving averages, because currently really in my personal trading strategy, I don't like to fight momentum. So I would really need to see bullish momentum. Alternatively, let's say shares continue to roll over and we come back down to test this support level at $23. Well, I think this $23 support level, given it held in early July and it held in May along with a late June, I do believe this level would once again hold and move higher over the coming weeks. So, either two situation happens, I will jump into shares for Penn Entertainment. So with that being said, I'll keep it moving here. Let's take a look at some fundamentals of the company. So I'll run through this article briefly. Obviously, for those that don't know, the acquisition of Barstool Sports has strengthened Penn's presence in the sports betting industry, providing a means for advertisement with a high brand loyalty, and showing strong growth in cross-platform views and social media followers. So definitely, the Barstool acquisition has worked pretty well for them. And then after dismissing Barstool host Ben Mitz due to racially offensive remarks made on a live stream, Penn has hit a 52-week low at $23, a far cry from the COVID rally of $130. The company has a well-rounded has had a well-rounded rebound with revenues above pre-COVID levels, expansion into digital markets, and over $1.5 billion in cash equivalents and securities on hand. So massive cash holding for the stock, which is awesome to see. And then this kind of shows you the geographic diversification of its facilities here. So a ton of stuff in the Northeast, and then a lot in the South, not much in the Midwest, and in the Northwest. So interesting to see there. Definitely a their corporate office, in the Northeast as well. So solid diversification of its facilities throughout the U.S. And then just to read out this investment thesis, because I do agree with it, they do have a consistent track record of positive cash flow, which I love. So Penn has demonstrated a remarkable track record of consistent positive cash flow over the past 13 years. Even amidst the COVID pandemic, the company was still able to have positive cash flow. So the company has effectively utilized its cash from operations to fuel its expansion into the digital gambling sector through iCasino and Penn Game Studios. So digital gambling really a massive market, and could be a huge growth driver for shares. They've experienced impressive growth with rates of over 31% and 42% respectively for iCasino and Penn Game Studios. The prudent approach has enabled Penn to strengthen its position in the industry and seize new opportunities. So you can see that free cash flow growth, play out here. 2009, much less, obviously a huge jump from all those numbers. So good to see that there. And then the benefits of tech stack becoming evident. So their performance in Ontario illustrates the meaningful strategic advantages of a fully owned tech stack in providing a blueprint for success for U.S. post migration. So they've been able to cross sell, right, with their online betting to their casino betting. So the cross selling has really been quite advantageous for the company. So you can see the Ontario growth here. So the iCasino is actually a big part of the pie. More people really wouldn't assume that, and I'll read out what it says here. So Ontario continues to be our top market in the North America for both sports betting and iCasino, with strong growth and encouraging trends through the NBA and NHL season. And then on February, the company completed its acquisition of Barstool Sports, which continues to build its audience through a diversified mix of highly engaged content. So obviously, you all likely know Barstool. They have a huge digital reach. So having that reach really just allows the company to push out all their gambling businesses to consumers who are in that right age range, right? They're all mainly pretty young, so good to see there. And then there's a lot of retail growth prospects as well for the company. And then so the total sports betting revenue in the United States has jumped at an extreme pace. Obviously, you would probably assume this even without seeing this chart here, but the markets that Penn is in have extreme growth potential. And we can see the compounded annual growth rate for the next 7 years of U.S. online gambling is 12%, which is a massive growth for a specific sector. So awesome to see that they are in sectors which are growing at an extremely fast pace. So I'll dive through some of their financials here. So I'm going to be using Seeking Alpha, which puts all these companies' numbers relative to peers. So in terms of valuation, the company ranks out as a B plus, and that is pretty solid when you put it on the Seeking Alpha scale. So their PE is at 13 times, and their PE for the next 12 months is actually projected to be 8.9 times. And if you take a look at Penn's 5-year average, so their 5-year average is 21 times PE. So they're going to be trading at a 9 times PE. That means that they're trading at a 58% discount to where they typically trade historically, which in my opinion provides a massive opportunity for investors who kind of have the stomach to jump in here while things aren't so rosy. And then really my favorite valuation number for the stock right here is price to book. So you have a price to book ratio at pretty much 1. So that means the stock is trading at parity to its book value. And to kind of put that in simple terms, the price of the market, the price of the shares that are being traded, also known as the market cap, equals the book value of the stock. And for those that don't know, book value is simply cash on hand, equipment, property, very firm assets, right? So this is a really cheap number right here, and definitely signals that the stock is trading extremely cheaply, especially when you consider its 5-year average, right? So the price to book ratio typically is 9 times. So this number is typically 900 times greater. So we're at a massive discount, right? We're at an 89% discount to historical average for price to book ratio. So valuation really does look good for the stock. And then when we take a look at the growth metrics for shares, so we can see revenue growth year over year is at 5%. So the company is growing revenue at 5%, which is below the sector median and below the 5-year average. So when we take a look at these growth numbers, we kind of understand why investors are not paying up for the stock right now. And it's really because that growth is not rationalizing high valuations. When you have a stock that's growing at 5%, that's a pretty weak number, especially for the sector. So that definitely signifies to investors that, hey, we're kind of slowing growth, and you probably shouldn't pay up for shares expecting to have massive growth in earnings over the next couple of years. So the valuations trading at lower than average for the stock is really being caused by growth being lower than average for the stock. So, that kind of rationalized that lower valuation a bit. Not super shocking to see that those valuations pretty low. And then when we take a look at profitability, so profitability numbers look still very healthy for the stock. So gross profit margin is at 46%. That gross profit margin is just revenue minus cost of goods sold. For those that don't know, that is simply what a company makes when it sells its products. So I always give this example. I'll give it here. So if I was starting a lemonade stand and I was selling lemonade for $1, excuse me, and I was selling lemonade for, let's say, 66 cents. Well, then I would be making 46% on every single cup of lemonade that I sold. That essentially is what this gross profit margin is telling you. The company is making 46% on every single sale that they have, and this profitability metric is actually in line with the company's 5-year average. So awesome to see that there. Although growth has somewhat faltered, their profitability metrics haven't kind of been shaken whatsoever. So that's solid to see. And this is above the sector median of 35, so all pretty solid numbers there. All right, so this is a very, very solid number for the stock. Cash per share is at $8.60, and just to kind of give you a kind of context behind that means that the market cap, 33% of the market cap is in cash, which plays into what I was saying before, that this company has a massive cash balance sheet, which really makes it impervious to general swings in the market. Well, maybe impervious isn't the right word. It makes it less affected by drops in revenue, and the company shouldn't have to raise any capital, they shouldn't have to do any share dilution, which investors obviously hate over the next couple of years, given this cash balance, which is definitely a good thing for shareholders. And then one other thing I'll cover here is net income margin is at 10%, which is a really good number. This is double the sector median and is actually above Penn's 5-year average. So profitability overall looks extremely healthy for the stock. And then with that being said, let's take a peek at how all these financials compare to the peers here. So first off, let's take a look at some recent trading. It looks pretty sad, honestly. So the stock is down 10% for the past year, but every single peer is up. In fact, the next closest peer is up 52%. So the stock is massively underperforming the market right now. So that is something you must be aware of. But obviously that could all turn around, right? Like I said, P of 8.9, and this is above the peers, right? So DraftKings isn't profitable, FanDuel isn't profitable, and these other peers are profitable as well, but they're trading at higher multiples. So right now, for every $1 in earnings, investors are willing to invest $8.9. I mean, excuse me, $8.90 into Penn. And then for the other stocks, that's much higher, right? So good to see that the valuations rank out pretty solid amongst peers. When we look at growth numbers relative to peers, we understand why valuation ranks out good. That is because Penn is growing at 5%, and DraftKings is obviously growing at a massive clip. FanDuel as well, and the other closer casino peers are growing at higher rates as well. And then gross profit margins still look extremely good when you compare it to peers. So we rank out as the third best gross profit margin when you compare the stock to peers. So you can see here DraftKings at 34% gross profit. So Penn is beating that. FanDuel beating Penn by 12 points there. And then we're basically in line with the closer casino peers. And then let's take a look at short interest. So Penn has the highest short interest of all of these stocks. So that kind of provides some potential for a short squeeze, obviously. But like I say, for every stock, there's always a reason why investors are sold short, and that is likely due to the poor growth numbers. Let's take a look at its cash position. So the company has $1.3 billion in cash, but the company has $11 billion in debt. So that's not the best situation to be in. You may be under the gun, and obviously I said earlier in the video that shares were not likely to be diluted, but honestly anything is possible. And when you take a look at this total debt number of $11 billion, it's a little it kind of plays the other argument, the other side of the argument that Penn could actually issue shares. It is possible, right? Because the company does have a ton more debt than it does cash, and that could be likely playing into that short interest that we're seeing. So DraftKings has a pretty good cash position, has $215 million more debt than cash, and then FanDuel has $4 billion more debt than cash. So FanDuel's in kind of a precarious position as well in terms of being under the gun with a share issuance, which would obviously hurt shares. And then the closer casino peers are all kind of in line, besides this one here, with Penn in terms of its debt position. But Penn definitely has the worst, the most debt relative to cash of all the peers, which is never a great thing, to be frank. But net operating cash flow looks very healthy, and it ranks out as number one for when you compare it to all peers, which is likely why the company feels very confident in issuing debt, because they are very confident in their operating cash flow, which is coming in and is likely being spent on future funding and paying off debt. So that is kind of how Penn ranks out relative to peers. And then when we take a look at analyst rankings here, or analyst ratings, I should say. So there are 12 different analysts with buy ratings on the stock. 4 are overweight, 7 hold. So this tells you that there isn't a single analyst, there isn't a single covering firm that has the kind of nuts, if you will. Probably not a good not the best word I could find there, but no firm has the courage, that's a better word, no firm has the courage to to put out a sell rating on this stock. In fact, the consensus price target is $51, nearly doubling the current price target. I mean, the current price, and the lowest price target is 26 bucks. So generally, when you look at Wall Street, all these firms are quite bullish on shares, and the general consensus is that Penn Entertainment should be trading at a higher price right now. So that's definitely good to see. That's definitely these analysts ratings are on the side of the bulls. So awesome to see there. So with that being said, I'll just kind of briefly explain. I think Penn is likely bottoming at that $23 support level. Valuation looks extremely low. Growth is a bit concerning, but profitability looks beautiful. And the company ranks out pretty solid relative to peers. I don't think the company should be underperforming the peers like it has been over the past year or so. So with that being said, I think Penn Entertainment could likely turn things around and move higher over the coming years. So with that being said, I will end the video there. If you got some value from this video, please leave a like. We post company breakdowns and important market moving news on this channel on a daily basis, so make sure you are subscribed. If you would like to receive my daily portfolio moves, my exits, my entries, and see how me and my team of analysts are trading the markets, join the Discord through the link in the description below to get our free 7-day trial. Also, if you would like to join our free daily newsletter, sign up to our Substack, which is linked below as well. With that being said, good luck everyone. Happy trading, happy investing.